The widening gap between silver and gold prices cannot continue indefinitely because both metals are tied to the same fundamental drivers: monetary policy, inflation, and the loss of trust in fiat currencies. History shows us that when this gap stretches too far, markets tend to correct sharply, often in ways that surprise investors. Silver, being both a monetary and industrial metal, sits at the intersection of two powerful forces. It preserves wealth during currency debasement while also being indispensable in technologies such as solar, electronics, and energy storage. As demand compounds and supply struggles to keep up, silver's undervaluation relative to gold creates a setup where an explosive rebalancing could occur, potentially multiplying its value against gold many times over. When you think about the relationship between silver and gold, it's easy to get caught up in the day-to-day price moves and forget that there's a much deeper structural dynamic at play. Both of these metals have served humanity for thousands of years as stores of value, mediums of exchange, and more recently, as hedges against the instability of paper money. But here's the thing. When you zoom out and look at the history of how they've interacted, you see that the relationship is not fixed. It swings, sometimes wildly, depending on the balance between supply, demand, and the confidence people place in the system around them. And right now, that balance is stretched in a way that signals something dramatic could be coming. Silver is often misunderstood because it straddles two worlds. On one hand, it behaves like gold. It's scarce. It's been used as money for centuries, and it holds value when governments print too much currency or when inflation spirals. On the other hand, it has a very practical side. It's consumed in industry, especially in technologies that define the future: solar panels, electric vehicles, advanced electronics, and even medical equipment. That means, unlike gold, which mostly just sits in vaults, silver gets used up. It's burned into the infrastructure of the modern world, which limits how much of it can be recycled and returned to the market. That dual identity is crucial because it sets the stage for what could be a massive repricing. If you look back in history, the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has swung between extremes. In ancient times, it hovered closer to 15 to 1. In more recent decades, it stretched well above 80. Right now, we're in one of those historically extreme moments where silver looks abnormally cheap relative to gold. What history teaches us is that extremes don't last forever. They self-correct. The question is never if they will correct, but when and how violently. That's why the possibility of silver moving to 9 times the price of gold by 2026, while it sounds shocking on the surface, is less about speculation and more about understanding cycles that have repeated again and again. Here's the mechanism. When people lose confidence in fiat currencies, they seek alternatives. Gold typically gets the headlines because it's the more recognized safe haven. But once gold starts to run, silver doesn't just follow, it tends to overcorrect. Investors suddenly remember that silver offers the same protection, but at a fraction of the price. That's when the floodgates open. The crowd moves in, industrial demand continues unabated, and the supply, already tight, can't keep pace. Silver is mined largely as a byproduct of other metals like copper and lead, which means supply can't simply be ramped up to meet new demand. That structural bottleneck magnifies the price surge, and historically it's why silver's moves have been more explosive than gold's. Now let's layer on the current environment. We are living in a world of record debt, unprecedented money printing, and governments that are boxed into a corner. Central banks can't raise interest rates too high without crushing their economies, but they also can't keep printing indefinitely without undermining confidence in their currency. This creates a perfect storm for hard assets because people intuitively know that the paper they hold in their hands is being devalued. Gold benefits first, then silver, with its much smaller market size, acts like gold on steroids. It doesn't take a huge flow of capital to ignite a massive move. At the same time, the industrial demand side is growing at a pace we've never seen before. The world's push toward renewable energy and electrification is silver intensive. Solar panels alone consume hundreds of millions of ounces every year, and that demand is projected to keep climbing. Electric vehicles need silver for their electrical systems. Electronics and AI infrastructure require it. Even healthcare is increasingly dependent on silver's antibacterial properties. Put simply, the more we push into a high-tech and green future, the more silver becomes non-negotiable. That industrial tailwind means even if investors don't wake up, the physical market itself is tightening, and when investors do wake up, you get a collision of forces that can move the price in ways most people can't even imagine. The reason this matters for investors is that markets don't give warnings in advance. By the time the narrative shifts and everyone on TV is talking about silver, the big moves will already have happened. What looks like a far-fetched prediction today, silver climbing multiple times relative to gold, will suddenly seem obvious in hindsight. That's the nature of paradigm shifts. They catch people off guard, but when you study enough history, you see the same patterns repeat. Extremes are followed by reversions, bubbles by crashes, and undervaluations by revaluations. So how do you prepare for something like this? You don't wait for confirmation. You position yourself with an understanding of probabilities, not certainties. The probability that silver remains cheap forever relative to gold is extremely low. The probability that industrial demand and monetary demand collide in a way that forces a repricing is extremely high. That doesn't mean it happens overnight. It could take months or even a couple of years. But if we're looking at the horizon of 2026, all the ingredients are there. A monetary system under strain, governments with limited options, a wave of technological adoption that eats into supply, and a global market that has consistently overlooked the strategic importance of silver. And here's another factor people don't often consider: the psychology of scarcity. Gold is scarce, but everyone knows that. Central banks hoard it, and nations measure their reserves in it. Silver, in contrast, flies under the radar. But when the crowd realizes how little silver is actually available relative to demand, the psychology flips. Suddenly, people aren't just buying it as a hedge, they're scrambling to secure what little is left. That scramble is what drives price moves that feel parabolic. And it's not unprecedented. We've seen silver spike multiple times in history when conditions aligned, most notably in the late 1970s. Those who were paying attention back then witnessed how quickly silver can go from being ignored to being the hottest asset in the world. So when we talk about silver potentially rising to 9 times gold, the important thing isn't the exact number. It's the recognition that the relationship between the two metals is broken, and it won't stay broken forever. Silver has the leverage, silver has the industrial demand, silver has the scarcity, and silver has the historical precedent of making outsized moves when trust in the system falters. Whether it ends up at 9 times gold, 6 times, or even higher, the direction of travel is the same: a massive revaluation. Investors who ignore this dynamic because it sounds too extreme are falling into the trap of linear thinking in a nonlinear world. Markets don't move in straight lines, they move in waves, and the biggest opportunities come from recognizing when the next wave is forming. Right now, silver is sitting at the base of what could be one of those historic waves. And if history is any guide, by the time the mainstream catches on, the move will already be well underway.